Welcome to this tutorial about reading a loan estimate, which is a very important document because it's going to explain what the terms are that the lender is offering. On the first page, it's a little bit confusing because it's really just a summary. So you see some large numbers on here, but on the second page, it's going to detail everything line by line. With that, let's get started. On the loan estimate, page 1, up in the top left corner, you'll see the date that it was issued, who the applicants are, the property address, and the sales price. And then on the top right, it tells you the loan term, whether it's a purchase or refinance, if it's a fixed rate or adjustable, the loan type, rate lock. This is very important. If your rate is locked, then the terms typically cannot change. At least the lender terms cannot change, which I'll get to in a moment. If it's not locked, then everything can change. The rate can change and the terms can change. So if you go down, just as it looks, you've got loan amount, interest rate, monthly principal and interest. It also will let you know if there's a prepayment penalty. I'll be honest with you, I haven't seen one of those in 10 years, but in this example, it does show that there's a prepayment penalty and it spells it out for you. It does not look like there's a balloon payment, which again, I haven't seen those in years. And then principal and interest, mortgage insurance, if it's applicable, will show up here. The estimated escrow is property taxes and homeowners insurance. And then it will show the total estimated monthly payment. Now, the mortgage insurance, it's important. If you look over to the right, it'll say years 8 through 30. That's basically telling you that after 8 years, or in year number 8, the mortgage insurance will drop off. Now, go down below, it shows the estimated taxes, insurance, and assessments are $206 a month, which includes property taxes and homeowners insurance. And then the estimated closing costs and the estimated cash to close. Now we're going to move on to page 2. Page 2 is a breakdown of the numbers that we just saw. Now, loan cost in Section A, these are the fees that the lender charges. All of the other fees that you see on this page are not charged by the lender. They're charged by different companies that perform different tasks. The origination charge, some lenders charge them, some don't. The origination charge is what they charge their fee. And then you'll see 0.25% of loan amount points. That's if you voluntarily choose to pay extra money to get a lower interest rate. That'll show points. There's an application fee and underwriting fee with this lender. What you need to know is it doesn't matter what they call the fee. Section A are the total lender fees. Section B, these are services you cannot shop for. And the reason why is that the law states that the lender must order these services and have control from the order all the way through closing. As you can see, there's itemized items here, appraisal fee, credit report, flood certification. I've never seen a flood monitoring fee or a tax monitoring fee, but this is the example they gave us. And then tax status research fee. And then down in Section C, these are services that you can shop for. These are going to be like the settlement agent, home inspectors, title insurance, whether or not you choose to have a property survey. We have to disclose it, but we have no control over these fees or which inspections you're going to have. Then, when you add up all three of these, you'll see total loan cost, A, B, and C, $56.72. That's adding up all of these estimated fees. Now we're going to go to the next section, which is other costs. These are taxes and other government fees. Now, the way I like to explain this is if you didn't have a mortgage, you would most likely still pay the fees over here in sections E, F, G, and H, because these aren't necessarily mortgage related. These are things that you would pay for whether you paid cash for the home or got a home loan. So the homeowner's insurance premium, most people are going to have that, even if they pay cash. They're collecting 6 months. Typically, they collect 12, but on this example, it shows 6. And then homeowner's insurance, they're going to fund the escrow account for 2 months. If you have questions about escrow accounts, I have a video on that breaks that down in detail. You're also going to see in this section G, property taxes. That's also going to be collected to fund the escrow account. H is other, if there's any other things like owner's title policy, which is optional. And so if you add up all of those fees in section I, that's what comes out to that number, $23.82. So if you take the total closing cost down at the bottom left and you add the other cost, the complete total is what you see here at $8,054. And if there's any lender credits, it'll show up in this section. So calculating cash to close, it shows the closing cost. It shows your down payment. It shows your deposit that you made when you made the offer to the seller. And then the estimated cash to close would be $16,054. Why? Because the closing costs were $8,054, and then you have your down payment, but then you have your deposit. So if you subtract the deposit from those other two items, the difference is $16,000. Hope that makes sense. Now let's move on to page 3. So page 3 is just additional information about this loan. It has the lender's name, the loan officer's name, their license number, the email address and phone number. And then up in the top right corner would be if it's a mortgage broker. And then you drop down and it shows in 5 years, this is the total you would have paid in principal, interest, mortgage insurance, and loan costs. And the amount of principal would have been $15,773. The annual percentage rate is basically the best way I can explain it is if you had no fees at all, your APR would be the same as your interest rate. But because there are fees, they add the fees to the loan amount. They spread it out over the term, in this case 30 years, at the interest rate, and then that spits out a number, and that's the annual percentage rate. The total interest percentage basically means if you add up all the interest paid, assuming you make minimum payments over the term, 30 years, your tip or total interest percentage would be 69.45. And then they have any other information that you need to know will be below that, like other considerations. Appraisal will let you know that they have to have an appraisal done on the property. Assumption means that loan is assumable. Typically, only VA and FHA loans are assumable. Homeowners insurance breaks it down. Late payments tells you how much it will be. If you're going to refinance, potentially you could do that. Servicing, in this case, the lender is planning on transferring your servicing, which just means that another lender is going to take this loan over. They're going to basically buy it from your lender, and then they're going to handle the collection of monthly payments, and then they're going to pay whoever buys your mortgage as an investment the interest every month.